Good afternoon, everyone. This is Edward Talisse for Chelsea Global Advisors and the CQF Institute. It's the 5th of December, 2014. It's been a couple of weeks since we last chatted about the market, and what I thought I'd do today is talk a little bit about some broad asset class returns over the last 7 or 8 years or so, and then after we do that, to talk a little bit about some of the major issues that may be on investors' radar screen for 2015. Before I jump into that, I just wanted to recap what's been going on in the financial markets since we last spoke a couple of weeks ago. So here in the U.S. at least, asset markets led by the S&P and the Dow Jones Industrial continue to trade extremely well and are almost on a daily basis taking out new highs. So it looks like the S&P and the Dow are going to end up with low double-digit returns for the year. Bond markets globally continue to trade at very low rates on the interest rate side for sovereign government bonds. 10-year notes in Japan are around 40 basis points. German government bonds are around 70 basis points, and U.S. 10-year notes are around 230. Credit spreads in investment grade and high yield markets, they've come back a little from the wides that we saw in the middle of October, but they're really far from the tights that we've seen in 2014. So credit has not really performed as well as some of the other risky asset classes so far in 2014. And I think our investment framework that we've talked about for many, many weeks, the 3 key pillars that I think drive asset class returns, first one being liquidity, is largely in place. Bank of Japan and the ECB seem set to continue to provide ample liquidity. Even the Fed, although they are in the process of ending their bond purchase program, continues to provide ample liquidity at very low interest rates. So that pillar is very much in place. Second pillar that we talk about is inflation expectations. They continue to be very, very well contained, and in fact are declining in Europe and in the US. They've stabilized somewhat in Japan, although the stabilization of Japanese inflation expectations probably has more to do with administered prices and taxes than with what's going on in the real economy. And then the final pillar that we talk about, which is corporate earnings and corporations' ability to pay dividends, certainly from the end of Q3, earnings cycles seem to be firmly in place. So those 3 factors continue to provide extremely generous support to asset prices between now and the end of 2014. So looking at asset class returns from 2007 into 2014, which is this color-coded grid that you have in front of you, I think a couple of interesting things come out. Firstly, commodities, which have absolutely gotten trashed this year so far in 2014, really other than in 2009 and 2010, have showed very, very poor return profiles during the last 7 years shown up here, and obviously will show a very poor return for this year. This year's outsized losses in commodities is clearly driven by the large decline in oil, but other commodities are trading soft as well, such as natural gas and gold and silver. U.S. equities last year had a very good year. You could see that in the purple box under 2013. Looks set to continue this year as well, so we're expecting very good gains there. So far for 2014, what's been the best investment class to have? Well, I've designated here by IYR, which is a broad-based real estate ETF, a REIT ETF. It's going to be up about 25% for this year. Real estate, particularly here in the U.S., is traded very well. Prices are appreciated smartly, and low interest rates have also helped the REIT sector because a lot of the REITs tend to be leveraged and they borrow money. Behind REITs, the S&P looks to be the second best performing asset class for U.S.-based investors. It's going to have a return of around 12–13%, barring any drastic changes between now and the end of the year. I guess more surprisingly is U.S. dollar, which is denoted here by an ETF called USD. It's a dollar portfolio held against a broad index of other currencies, mostly euro, yen, and sterling. Obviously is up smartly for the year. I don't think coming into the year a lot of people thought the dollar would perform so strong. On the other side of the ledger, DBC, which is down here. This is one of the probably highest capitalized commodity ETFs are out there. It's going to end the year around 21, 22%, again, driven mostly lower by the drastic decline in oil. EFA, which is a broad-based ETF that gives an investor exposure to equity markets in Asia and Europe, is going to be a small decline for the year. And gold, at least is stabilizing here. It's going to have a return between down 1% and 2%. But I do think it's interesting that gold, unlike some of the other commodities since 2007 at least, have shown some pretty stellar returns. So I think gold, makes sense to be part of most investors' portfolios, although it had a very, very bad year last year. At least it seems to be stabilizing somewhat here. Lastly, I always like to point this out that just holding cash or T-bills, continues to be a losing proposition. BIL is a ETF that just holds very short-dated Treasury bills. Treasury bills earn zero, as everybody knows, but after transaction costs, probably gives a small negative return. I guess also surprising for 2014 is positive returns in a broad-based bond market index, which is represented by the Barclays Aggregate Index. It's up 3% for the year. And I think coming into the year, most experts and investors thought that interest rates would rise quite significantly and really hurt bond performance, but that clearly hasn't been the case. So that's what's happened over the last 5 years and going up into the end of this year. So what about 2015? So I think on this slide, what I tried to do is to show the predictable uncertainties that all investors and money managers face for next year and beyond. Myself, I don't like to make big, drastic, or earth-shattering predictions. I think it's a very difficult thing to do, but I think it's fair to say that these issues that are on this slide here should be thought about. And if investors believe that they could come up with the right consensus on how some of these things are going to play out, the asset allocation decisions for 2015 and beyond become much more easy to do. So firstly, we always talk about inflation versus deflation. So far, the people in the deflation camp are holding all the cards. Inflation expectations have declined dramatically in the U.S. and in the Eurozone. Certain short-term interest rates are negative. They're negative in Germany. They're negative in Switzerland. They could go negative here in the U.S. at the very short end of the curve. So at least for the moment, inflation does not seem to be a concern, but deflation is definitely a concern. Commodity cycle, I think, is another very, very important topic for investors to consider. The commodity super cycle seems to be far, far in the rear view mirror, and as economics would dictate, as the higher prices of previous years in some commodity cycles brought a huge amount of new supply online, particularly in the energy sector, it seems like commodity prices are set to decline further. U.S. dollar strength, I think this is a question of relative beauty instead of absolute beauty, with the Bank of Japan and the European Central Bank beginning to print more and more beginning to print more and more local currency, and the U.S. at least on temporary hold from their quantitative easing program. The U.S. dollar seems to be a currency of choice for the moment. Investors need to think a lot about what's been going on in Japan. Japanese equities in 2013 had a great year, but the yen declined quite significantly. It seems like Abenomics has stalled, particularly on his third arrow. The prime minister there in Japan has called a snap election, and I think the outcome of those elections will be very important to determine if Abenomics can really carry through and get Japan out of its 20-year sort of malaise period. And then speaking of malaise, we always like to talk about Europe. The continent represented by the Eurozone continues to face a lot of problems. The ECB seems to be set on starting its own quantitative easing program, but it's yet to pull the trigger. The conflict between some of the larger European nations like Germany and France against Russia seems to be hurting the real economy over there. And European assets, other than government bonds, have traded quite poorly for 2014 and probably looks set to trade poorly for 2015, at least compared to the U.S. markets. The other issue that investors need to contend with are super low G4 government bond yields. By G4, I mean the UK, the US, Japan, and Germany. These yields effectively mean that term premiums and risk premiums in other asset classes are forced to come down, and it means that people have to take more and more risk to earn outsized returns. And then, of course, what we need to worry about and think about next year is everything else, all the things that I'll never be able to predict or think about. Just like this year, nobody really had a drastic decline in energy prices on their radar. There's going to be plenty of things next year for us to talk about and to worry about. You could find these two slides on the CQF Institute's website and also on Chelsea Global Advisors' website. If you have any questions, please reach out to me. You could find the email address on Chelsea Global Advisors' website. Thank you very much and have a great week.